If somebody tells you the number one reason to refinance is to get a lower interest rate, they're steering you wrong. The interest rate is a means to the end, but there are actually only 3 reasons to refinance, and none of them have to do with interest rate. The first reason is to pay your home off faster. The second reason is to decrease your monthly payment. And the third reason is to pull cash out. Now, I want to explore all 3 of those in a little bit more detail. So first of all, pay your home off faster. That one has to do with how much you're paying in interest. And obviously, if you're paying your home off faster, you can do that by adding to your current mortgage payment and just simply pay your home off faster. But the idea is, if you can decrease the amount of money you're paying in total interest, then you can continue making the same monthly payment and be debt-free sooner. Now, this strategy works for people who have more than just their mortgage debt. If all you owe is the money on your mortgage, your first mortgage, your primary loan, then you have to have a lower interest rate than what you're paying today in order to pay off your home faster and make the same mortgage payment. That's simple math. But if you have other debt, especially credit card debt, or you've got home equity loans and lines of credit, what we look at then is consolidating your debt without decreasing your monthly payment. So let me give you a simple example. Let's pretend that your mortgage payment is $3,000 a month, principal and interest payment, and you have 20 years left on the loan, but you owe $40,000 in credit cards, and your interest rate on those credit cards are 25%. Maybe you have a $30,000 home equity line of credit that's at a 10% interest rate. When we add up the total balances that you owe on all of those debts, and we add up your total monthly payment, and then we put all of it together, comparing to one brand new loan, your monthly payment, often that you're paying today, can pay off all of your debt significantly faster. So that's the first way that we can decrease your term, owing nothing, being debt-free in a shorter amount of time, even if your interest rate on the mortgage is going up, because you're bringing down your average or blended interest rate. So that is an example of how we can decrease your term, whether the interest rate is above or below your current mortgage. But don't just refinance for a shorter loan. There are times when people say, hey, John, I was told by a lender that I can get I can go from a 10-year fixed, I've got 10 years left on my loan, and I can refinance into a 5-year mortgage. The truth is, you're spending money and fees to refinance, and your interest, even if they cut your interest rate, it's still not going to actually save you very much in interest, because over a short period of a loan, a majority of your payment is principal. So if you're in that situation, be cautious. If you already have a short period of time and you're shortening it even more, it often isn't worth the fees that it costs to do the refinance. Now, the second reason that I said is to lower your monthly payment. Now, obviously, you can lower your monthly payment on the mortgage by lowering your mortgage interest rate. But sometimes you can lower your monthly payment even if rates are higher. How do you do that? Well, first of all, you could stretch it back out to 30 more years. Now, for a lot of people, they say, John, that's horrible. I don't want to lengthen the amount of time. That is bad long-term thinking. And I agree. But if you can't afford to make the payment today, you're never going to make it to the long term. You're looking at short-term versus long-term benefits. And in the long term, it's going to be more harmful to stretch out your mortgage. But if you can't afford the monthly payment, if you're going deeper in credit card debt every single month because of the fact that you're so focused on this low interest rate and the short term that you have left, but you're robbing Peter to pay Paul and you're getting deeper in debt over here, you're not helping yourself. And so you have to understand there's a big difference between short term and long term. And sometimes extending out the term of your loan is a better plan to save you off of your monthly payment. You also can get rid of your mortgage insurance. If you're paying mortgage insurance, if you took out an FHA loan, your mortgage insurance is paid forever. Maybe 11 years, but most of them forever. If you put less than 10% down payment when you bought the house using FHA, you're paying your mortgage insurance forever. So you're in a position where you can actually save money per month, even if you didn't lower your interest rate. So it's not all about interest rate. And then finally, debt consolidation. Same as what I was talking about a few minutes ago, talking about shortening your term by consolidating all of your debts. Well, the truth is maybe in the long term, you would love to shorten your term, but in the short term, you need to take the monthly payment savings. And so in that situation where we consolidate all of your debt into one, we might not stretch it out to a full 30 years. We can talk about the pros and cons of that. The nice thing is we don't have to do a 30-year mortgage. If you have 27 years left on your mortgage, I can do a new loan with 27 years on it so that you don't add extra time if that's important to you. And the third reason to do a refinance that has nothing to do with interest rate is pulling cash out of the property. Now, cash out for debt consolidation, I just talked about when I talked about lowering your monthly payment. But now I'm talking about cash out for other needs. Maybe you have a kid that's about to go to college and you're saying, hey, I don't want a whole bunch of student loan debt. I'd rather have some tax deductible interest that I'm paying on my mortgage than to have all of these student loans that are going to hurt me or hurt my child. Maybe you want to do improvements on your home. Maybe you bought a house that wasn't everything that you wanted because there wasn't enough inventory out there to find the right home. Maybe you bought a house that was less than what you hoped for because interest rates were super high and you had to compromise on a lower priced home. But now is the time that you can pull cash out of the property. And sometimes it just plain is cheaper to do that than to move to a different home. Your property taxes are going to stay fixed at the lower amount if you're in California. If you're in other states, your property taxes go up all the time anyway. But in California, property taxes are tied to what you bought the house for. So if you're in California, that's another benefit of not moving. But no matter where you live, you're not only going, if you move to find a better house, you're not only losing the low interest rate you have and going to a higher interest rate anyway, but you're also paying fees. You're paying fees to the realtor to sell your home. You're paying fees to the realtor to help you buy a home. You're paying all of those fees to the mover to help you move from one house to another, or you're paying for pizza and beer for your friends to help you move. Either way, you have all of this cost and you're still going to have a higher interest rate than where you're at today. Or you can just pull cash out of your property. You didn't pay any real estate agent's fees for selling or buying the home. You didn't pay any fees to a mover to move from one home to another. And it puts you in a position that you can stay where you're at, where your kids know all the friends in the neighborhood. They're comfortable and established in that school. Pull cash out of the property, even if it's increasing your interest rate, or do a home equity loan or line of credit. So if you have any questions about this or anything else, let me know. I also want to remind you about our monthly home equity digest. If you're not getting one of these already, sign up for it. There should be a QR code floating over my head right now, and it'll also be in the description down below. It's called HomeBot. And every single month it's free of charge. So you're going to get a digest, a monthly email that's going to give you an idea of what your house is worth. That's automated, but it's going to talk about your progress. It's like the bank statement for your home equity. And it's going to show you how much you've paid down your balance, how much equity you now have, and give you some ideas of what you can do with that equity. So it's really, really critical that you're paying attention to your equity and using it in a smart way. And the best place to start is to sign up for my free monthly home equity digest. Thanks so much for listening and hope you have a wonderful day. And please reach out because I am for sure interviewing to be your lender to help you make your home equity work for you.